Okay, we are live. Going to give everybody a minute to join. We had a lot of excitement about today's discussion. Hundreds and hundreds of RSVPs and registrations for today's conversation, and really excited to get into it. Just to start, my name is Josh Shamster. I'm the Chief Revenue Officer here at StartEngine, and I'm going to be moderating today's conversation, which we're really excited about. This is one of the first times we've been able to bring on a guest speaker from the outside, and today we have a very special guest with us, who I will introduce in just a second. So on the presentation for today, we are going to have a conversation on the shift to alternatives, as obviously this space is garnering a ton of interest and excitement. We've seen this with StartEngine Private over the last couple of years and all the interest that exists within that business line at StartEngine. And so we figured it would be great to just talk about this space in more detail. And so for today, some of you may recognize our founder and CEO, Howard Marks. Howard is here with us today, and has been leading us here at StartEngine since our inception. And in addition to Howard, we're very excited to welcome Dr. Anthony Chan here this morning. Dr. Chan was the former chief economist at JPMorgan, and has been widely recognized as an expert in this space, has spoken in front of many different events and to many of the clients at JPMorgan over the years, including many of the central banks as well worldwide. So Dr. Chan, welcome to this conversation. Thank you for joining us. And one thing I want to say before we kick everything off is we are going to have time at the end for questions. So if you have any questions, please leave those as comments on the side. I'm going to address those questions to our speakers here today as we get into the conversation, and so please feel free to leave any questions as you go into things. Again, please leave your comments and questions on the right-hand side. We will get to those at the end of the conversation. I do think Dr. Chan had to jump off for just 1 second. I was having some audio issues. So Howard, can you hear me okay? Is everything good on your side?
Okay, we're good.
There we go. Beautiful. Okay. Well, I gave you a beautiful introduction. I'm not sure if you heard it or not, but to welcome you again, Dr. Chan, welcome, the former chief economist at JPMorgan. We're really excited to have you. Thank you for joining us today.
Oh, thank you. I was able to read your lips, so yes, I did hear it that way.
All right, good. Well, Howard, I know there's a lot of things that you want to get into with Dr. Chan, so I'll let you take it away and start our conversation for today.
Great, thank you, Josh. Yeah, you know what? I think one of the things that we are very focused on our mission, which is to help entrepreneurs and investors to achieve their dreams, is we've really tried to innovate a lot in how investors can have access to private equity. However, this is like a big word. It's interesting. I think there's a lot of excitement out there, but now we're so glad to have Dr. Chan here, who has studied this for quite a long time and has his views. And for me, I'm fascinated to hear his views and how he sees private equity existing among the portfolios of investors who typically have been offered a lot of other things but private equity. So thank you, Dr. Chan, for being here. First question I have for you is, could you please give a little sense to our audience of, you know, what is the kind of recent history of private equity? How was it before? How has it evolved? Where do you see it now?
Well, Howard, I am very excited about private equity. And the reason why I'm excited about it is because if you look back across time, private equity over long periods of time does generate higher rates of return than the public markets. There was a recent article on institutional investor of a study by private capital advisors that basically showed that from 2000 to 2025, you basically got about 480 basis points more in private equity compared to public markets. Now, the critics will say, well, if you look at the last 25 years, there have been some years where the public markets have outperformed private equity, and some years where the private equity has outperformed public markets. But that's not the issue. The issue is that over long periods of time, you do generate higher rates of return in private equity. And that's the reason why you're hearing more, Howard, about talk out there that they're thinking about putting private equity in 401k plans. Because if you take a person that's young, 20, 25, 30 years old, and they're entering the labor force and they invest in private equity, and they're not going to retire for another 25, 30 years, you can see that it's a much higher rate of return. So that is what really is getting me very excited. Then one second point that I will make is that some people say, well, we think that private equity is probably going to yield lower rates of return moving forward. And how can you sort of make that argument go away? And I say it's not so much the rate of return of private equity, even though it's important. It's the differential between private equity and public markets that matter. We know that public markets have gone up to very high levels. Price earnings ratios in public markets are much higher than the historical levels. And so some people would argue that public markets are going to generate somewhat lower rates of return. But again, not only is private equity good for diversification, but more importantly, and here's the secret sauce, it generates a higher rate of return than public markets. That's what investors should be excited about. That's what investors need to be focused on.
This is great. And so you mentioned the new labor department Department of Labor, said, hey, you can put private equity in 401ks, which is great. But when they say that, what they're really saying is take a fund that is created by one of the big private equity players in the market, put that fund in the 401k, offer that as one part of the portfolio. But are they talking about owning a SpaceX or OpenAI or some really exciting pre-IPO company, or they're talking about something different?
Well, Howard, these are all baby steps. The fact that they are inherently telling investors that private equity is something that can go in your 401k should open up the eyes of all investors. Now, we know that when you invest in private equity, there are going to be big winners and there are going to be some that are not winners. Some of them that may be losers. For example, studies show that if you would have invested, say, $5,000 in Uber, today that would be worth $25 billion. But again, not every company is going to be a Uber. Not every company is going to be a SpaceX. So what is the secret? The secret is the secret is what you are doing, Howard, and that is to create these pools where you have multiple companies into private equity. And so the rate of return is potentially higher. So it doesn't mean that you have to invest in one stock, doesn't mean you invest in two. But if you invest in multiple, obviously the fund is an even larger extension of that. But the fact that they are now essentially realizing and blessing the concept of private equity should open up the eyes of all investors that private equity is something you should have in your portfolio. That doesn't mean, Howard, that your portfolio should be 100% private equity. It doesn't mean that even investments like crypto, that means you have to have 100% of your investment because some people think it's a good idea. It means that you should have an allocation to this asset class because it's an exciting asset class. And certainly history shows that it is an asset class that generates higher returns than the public markets. And that's what we should be excited about.
Yeah, I agree with you. So, I've been watching what Larry Fink was saying about the change of the portfolios to illustrate your point. From the 60-40, 60% equity, so that means what? Mutual funds, ETFs, stocks, and 40% fixed income, and that could be bonds, treasuries, you name it, CDs. And that was the traditional recommendation, I would say guidance that people have been hearing. And then suddenly it was changed. And it's now 50, 30, 20. So 50%, Equity, ETFs and mutual funds, and then 30% let's say call it income, and 20% private equity, and people are scratching their head. Okay, so great, private equity, and what does that mean? I mean, there's a lot of things that represent private equity, and how do I get it? Because it's nice thing to say this is what you should do, but I've noticed on the market today, when you go to see a registered investment advisor, you go and see a broker, typically they will put a great portfolio together, and I don't see any private equity. So what is going on?
Well, what is going on? It's so far it hasn't been in their interest to push in that direction, but the reality is that these private equity investments are generating outsized returns, and so it behooves an investor to certainly allocate some amount of their portfolio into this area. And I hope that these returns and the evidence that's out there, that, by the way, the evidence also shows that people that invest in private equity end up getting, in many cases, more than half of the returns that the other investors get after the companies become public. So in other words, if you enter the company before it becomes public, you generate not only big returns, but you generate higher returns than if you just go in afterwards. So why not go for the ride and get those higher returns when in many cases the returns are much higher before they go into the IPO than after they go into the IPO? And this is not something we're speculating about. There have been studies out there that actually show this. And this is the information that people need to know when they're making a decision as to allocate part of their portfolio into private equity.
So that illustrates the idea that, okay, maybe 10% could be private equity, maybe 20%, but certainly not more than that. And I subscribe to it. What you just said, Dr. Chan, is like, you got to balance your asset classes, because not you're going to get caught in some bad cycle. So one thing that private equity has is this issue of illiquidity, where when you buy a mutual fund and you're unhappy, you can sell. And unfortunately, a lot of people sell when it's down and they buy when it's high, which is not the greatest thing to do. But anyway, and illiquidity. So one of the aspects of private equity is it's not liquid. You can't just say tomorrow, I'm out, call the broker, I want cash, I'm gone. It doesn't work that way. However, at StartEngine, we've been thinking about this a lot. And one of the things I wanted to ask you a question is, you hear right now a lot of this idea that private equity could become a little bit more liquid, not necessarily like the stock market, of course not. But like, for example, we're thinking, hey, why not tokenize these private equity shares? So for example, Anthropic tokenize it so it's more portable, so it can go from one trading platform to the other, and offer that so that there is some form of liquidity, not necessarily great liquidity, but some form of liquidity. How does that change the asset class?
Well, I think it makes the asset class a lot more exciting. And by the way, this tokenization is not just something that is going to be unique to private equity. Tokenization is going to revolutionize the financial sector. It's going to make everything a lot more liquid. It's going to reduce transaction costs. It's going to allow trading virtually 24/7. There's not going to be any real constraints. So the tokenization is great. And it's also in other areas. I've written Substack articles that even standby letters of credit are going to be tokenized. So a lot of asset classes that get tokenized, you'll be able to sell them to other people and again, get that liquidity in a different way than actually going back to the person that actually created the funds. You'll be able to use these tokenized assets that are tokenized and trade them with other people. So if you want some more liquidity, you want some liquidity, you can do it that way. So that's going to be another opportunity to liquefy these things. And by the way, this is not a completely new concept, because if you know, a lot of the wealth managers out there have made alternative investing, and they made it a little bit more liquid. So they've moved in that direction. This will take it many, many steps even further to make this asset class even more exciting. And a lot of other illiquid asset classes. It's not just limited to private equity. We're going to tokenize a lot of different assets. We're doing it already.
So we, in 2017, introduced to the market a smart contract called ERC 1450. That was in 2017. That's when the SEC was a little averse to this whole idea of tokenization, but we did put it in place where it allows us and others to use the smart contract to tokenize private equity. Why private equity? Because public stocks, they don't necessarily need to be tokenized. They're public. You can trade them instantly. There's an efficient market. But for private equity, which represents a large class, probably larger than the stock market, and what I've read, we can now, with ERC 1450, which we introduced in 2017, and this week announced that we're going to tokenize over 400 companies and a value of about 3 billion, maybe more. We'll have to see when we calculate all of it, and give that to our investors. How does that change? How should that change their view of private equity?
I think it should change your view in a dramatic and almost in a revolutionary fashion, because once you get complete tokenization, then there are no more or very little liquidity constraints, because you can take those tokenized shares and trade them with other people and get your liquidity if you need to. Keep in mind, Howard, that in order to get the real high rates of return of private equity, you want to keep private equity for longer periods of time. That's why I agree with your view that you should have it limited to, say, 20% of your portfolio. You don't want to have 90% or 100%, because you don't want to have a situation where you have less liquidity. But with this tokenize, guess what it does? It allows you to stretch that share even larger, because if you wanted to have, say, a 20% share of your portfolio because you're worried about illiquidity, and now all of a sudden illiquidity is less of a concern, guess what? You can actually stretch that a little bit more. And remember that in terms of how much of a share of your portfolio in private equity should also be a function of age. If you're 20, 25 years old and you're putting it in investments for the future, you can afford to have a much larger. If you're our age, Howard, maybe a little bit lower share of your portfolio into private equity. But the fact is that any development out there that makes this asset class a lot more liquid is progress, and it certainly will allay the concerns of a lot of people. Let's face the facts. Rates of return are coming down. If you go back to 1981, Howard, the rate of return on a 10-year treasury was 15.84%. That's a pretty good rate of return. Maybe you don't have to worry so much about private equity. But today, the 10-year treasury yield is around 4.15, much lower rate of return. And then on top of that, the medical profession increasing the longevity and life expectancy of many different individuals. So not only do you have to worry that rates of return in fixed income markets have come down, but you also have to worry about we're going to live a lot longer. And if we're going to live a lot longer and rates of return are a lot lower, guess what? We're going to have to look at asset classes that give you a little juice, give you a little higher rate of return. And if we don't have to worry as much about that illiquidity, then it's a win-win situation.
So one last point I wanted to discuss with you, which kind of is top of my mind. A large portion of our investors on StartEngine who buy pre-IPO shares are buying just one, because they like the name. They think, wow, this is so cool. I can get to be an investor like in Ramp, which had a tremendous raise. And then other names like Anthropic, and then they're done. That's it. They buy one, and it kind of makes me feel that they didn't get the message. And so how do you react to that? They buy one, they're done, and they wait.
Well, Howard, I've been working in Wall Street for 30 years, sat on the investment policy committee of JPMorgan for many, many years. And I think that the concept all the way back to the beginning of time of investments is diversification is key. It's the only free lunch, believe it or not, Howard. They say that there's no such thing as a free lunch in investments or anywhere else. Well, there's a free lunch in diversification. So what I would say to those people is, I can't tell them what to do because they're adults and they should make their own decisions. But I will tell them that they will be in a better position if they diversify and they increase the number of companies, because again, private equity yields higher rates of return, but the way the studies are done is a group of companies. It's not one company. Now, You mentioned some companies, like I mentioned Uber, and of course, we can mention many others where you got these really extraordinary returns. But Howard, I'm sure you can mention some names where the returns were nothing, or maybe those things went to zero. So you always have to have a diversification. And the reason why, Howard, because if you only have one, yeah, some people would be very excited. But suppose they pick the wrong one and they lose, then they don't want to be back in this asset class, which would be a shame because this asset class gives you higher rates of return than public markets. So yes, you should diversify. And by the way, you should also diversify across the different types of private equity. For example, venture private equity or growth private equity. Studies have shown that the differential between the average rate of return and the median rate of return, whether you're looking at venture or growth companies, is different. You get a bigger disparity if you're going into venture, which means you could be bigger winners, but you get smaller disparity if you go into growth type of private equity. But again, that's for people that maybe want to take a little bit less of a risk. So by getting a pool of these companies, you may be able to get a mix of some that are super, super early stage, but a little bit riskier, or some that are a little bit more growth, a little bit closer to the IPO stage. And you're able to compress that rate of return and not sacrifice that much of return, but again, lower the distribution so that the tails are not as fat in the rates of return.
So it's interesting you mentioned that because we do have companies. Let's take Ramp, for example. When we introduced it to our investors, it was, I would call it a little bit earlier stage, it was not a pre-IPO. And then we have things like Anthropic, which is more on the later stage. And so what we found was that the names that they recognized, they wanted it done. And usually those names are more in the later stage. We call it pre-IPO stage, which is appropriate because, in most likelihood, that's what they will do when the market's open. But the earlier ones, because the name was not known to them, even though the company is great and the performance, that everything is great, they're not interested. And we're having a hard time really explaining that, so that yes, you don't know the name, but still a good potential. And the like you said, the returns are different than from a pre-IPO. What is the best way for us to educate our investors?
Well, simply ask the investors, how much of a risk tolerance do you have? As you point out correctly, these companies that are a little bit unknown, guess what? It will mean that you might get better pricing. And in fact, the data shows it. When you look at the studies out there, those pre-IPO, the earliest stage, they generate higher average rates of return than the growth ones, because the growth ones are established. They've gone through several rounds already of investment. So the rate of return is a little bit less. Still going to beat the public markets. So what is the solution? The solution is that if you get in the earlier stages, you're going to get a higher rate of return. But guess what? No such thing as a free lunch. That means a little bit higher risk. So the solution to that is put a number of them, put a mix of them, put several of them into a fund and let them invest not in one, but invest in maybe 4, 5, or 6 of these companies at the same time. So they realize they're taking a higher risk, but if they win, they're going to win because the rates of return are higher. So there's nothing wrong with that. So two different strategies here, Howard. One is to mix some of the super early stages with some of the more established ones where they know the names. So you get a mix of those companies. Or if you really want to go for the high juice and the high rates of return, go only for these super earlier stage companies, but put a mix of them there. Never bet on just one company, because if that company fails, you're going to have a bad taste in your mouth. You're going to think private equity is terrible, when in fact, the last 25 years show you that it's been much better way to invest, much higher rates of return. So what we want is for our investors to have a good experience. And the way to get a good experience is to diversify some of that risk. It is, as I said before, the only free lunch in investments.
Well, thank you, Dr. Chan. I mean, it's very helpful for you to illustrate that, because that's one of the items that when I talk to my team, I said, look, we need to educate our investors, because seeing them coming in with one investment. I understand it's great they did it. I'm happy they did it, but that's just not enough. It's just the risk profile is just your roulette. You put a number and let the roulette turn. And I rather be the house, where we know there's a better chance. Anyway, this has been great. Thank you, Dr. Chen. I give it back to you, Josh.
Absolutely. Yeah. So thank you so much for all of this. As the conversation has been going on, we've been getting a lot of great questions from the audience. So I do want to spend some time and address these questions. Dr. Chan, first one for you here. What is the typical timeline that investors should expect for possible returns by investing in this asset class?
I would like to think that you should actually think of a 5-year investment horizon. By the way, 5-year investment horizon is the same for the S&P 500. I never advise in all my 30 plus years of working in the wealth management area. I've never advised an investor to say, go ahead and invest in the public markets and keep your investments for 1 week and then see what your rate of return. So a minimum of 5 years. And keep in mind that with private equity, it probably should be even a little bit longer. But I'm saying at the absolute bottom, it should be 5 years, but it probably should be even a little bit longer. But again, if you're 20, 30, 35, 40 years old, having a 5 to 10 year investment horizon is not a bad idea.
Mm-hmm. Howard, for you, the question here is, does it make more sense for the retail accredited investor to invest in a fund of private equity companies versus pretending to be capable of just stock picking a number of different offerings?
Well, I think there are two clear choices here. We have offered single stocks because those are hard to get, hard to find, and we offer them on a one basis. And then we have other stocks that are not as well known, sometimes anchored by a well-known stock, and put that into a little fund, and we call it Catalyst or one of those names. And why did we do it? Because we found that our investors like the simplicity of being able to buy one small fund with 6 or 7 names versus single names. However, I think both are important because you want to have that diversification that Dr. Chan was talking about. So I would say I would love to see investors look at some of the bigger names that are hard to get and invest in those, and then also pick one of the funds. So then they have the ultimate best of both worlds.
Great. Dr. Chan, question here about the risk of investing in private equity versus the public markets. How would you compare the risk of the two different asset classes?
Well, we certainly have to be transparent and say that public markets, when you compare them to private equity, there's going to be a little bit more risk in private equity, again, because there's more unknowns. It's something that has started. The public markets are companies that have been tested. So there is a little bit more risk in private equity, but the rates of return can be much higher. There was a very interesting study that looked at the multiple on invested capital of private markets or private equity versus the public markets. And the multiple on invested capital over a 25-year period was 3x, 3 times higher. So that for every dollar that you invest in private equity, you would get 3 times as much as for every dollar that you invest in public markets. So Josh, if you're getting a 3x return on your capital, you can't expect the risk to be lower. You can't even expect the risk to be the same. But again, those higher rates of return should compensate you for that. And as Howard pointed out, if you're really careful and meticulous about this and you diversify, you can lower that risk significantly. But that's true in any market, and it's true in the public markets too. If you just invest in one stock in the public market, you're gonna face a higher risk than if you invest in several stocks. That's just a fact of investment.
Yeah, so we have another question that's covering that topic specifically. Howard, there's someone mentioned that they've invested in one StartEngine private offering previously. but they're unsure about how many investments that they should be making or even how much they should be allocating to private equity. What would you recommend that person do to build the strongest private equity portfolio possible?
And again, I think hearing what Dr. Chan said is very important. I looked at what Larry Fink was saying, the 50, 30, 20. I think 20 should be all private equity. That includes also private credit, and that includes real estate. These are asset classes that also have their own cycle. I think 10%. I like the word 10% because it's easy to remember. 10% of the portfolio of investable assets. So let's say they have $3 million of investable assets. That means like about 300,000 could be put in stocks that are pre-IPO or earlier than pre-IPO. Why? Because now that new asset class has a meaningful position in their portfolio. It's not just a blip. And so having the one stock only and then pondering, saying, "Hey, I don't know what else to do," I think is risky, very risky. So, I think we have a responsibility to make sure that our investors understand risk. And so having that diversification would be better. We also now allow investors to use their individual retirement accounts, the IRAs, to invest in StartEngine pre-IPO stocks, private stocks. And that is a great diversification as well, because now it's a tax advantaged account. It's done in a way that's very seamless. We use Equity Trust as our partner for that. So it's independent, it's in a trust, and that offers the investor another way to use their capital. And we see a lot of demand for that, which is great. So frankly, I think the response was good, but I think educating our investors to be looking at 10% is I think is a good starting point.
Yeah. And Dr. Chan, any tips or advice that you could give the investors when it comes to conducting due diligence on these opportunities, or what investors should be on the lookout for?
Josh, I always tell people that make investments to do due diligence. I think that right now, with the advancements that we have on the internet, the artificial intelligence, when you hear of a company, you can actually do a little bit of research on your own about that company. You can find out what that company is doing. You might be able to find out what other people think about that company. So yes, doing a little bit of due diligence is great. But again, I also have to emphasize that diversification piece is also equally important, because a lot of investors, and again, throughout my career, that have done the research, what they do is they do the research, and if they really want to buy the company or they want to buy the stock, they pay more attention to the commentary that is positive and less attention to the commentary that's negative. And that's something that makes me a little bit nervous, that there is a bias. If you really want to buy something, you feel comfortable with the company, you ignore the negative and you just focus on the positive. So again, how do you make all this problem go away? If you invest in numerous companies, and then you don't have to worry as much. But no, nothing wrong with doing the due diligence. I would just advise those investors, please don't have a bias. If you're excited about something, do the due diligence with an open mind. That is, if the research and the commentary that you hear is positive, that's great. But if you hear that it's negative, please take that into account also.
Mm-hmm. Howard, on that same note, what is StartEngine doing from a due diligence standpoint to give investors confidence that what we're offering here at StartEngine Private is, a safe or a sound investment?
Well, safe it's not. Let's be very clear. When we put on the page the disclaimers, we say that private equity, you can lose 100% of your investment. That's very clear. And we put it there because we want everybody to know that, companies can go bankrupt. That happens. Or they can become decapitalized, where they don't have enough capital and then they have to sell themselves. And sometimes there are some different levels of securities in front of your security, and that could create a squeeze and a loss of your principal. So I think it's very important that investors understand that private equity, you can lose 100% of your principal. That's possible. That may not happen on S&P 500, obviously, But that's part of the reason why the returns are different for private equity, because you go from private equity, pre-IPO into IPO, into the public markets, and then you have your own a new destiny, a new life on its own. And so we say, look, that 10% is at risk, but if it's diversified, the risk is lower than that 100% risk. Like, see, if you buy one stock and it goes to zero, which is possible, what was that about? That's your entire portfolio. That one stock in private equity probably represents 1% or whatever, and you lose it. Okay, it's not a disaster, but what was that about? It was a non-event. Now, let's say you have 6 to 7 that you put in every year in your portfolio, 6 to 7 stocks. Now, one goes to zero, and another one does well, another one does not so good, the other one goes amazing, surprise. Now you're looking at your portfolio and say, wow, that was a good experience. That was actually a positive for my entire portfolio, because my private equity provided maybe the returns I was looking for, maybe not, but at least I've made that bet and that diversification. So I think the best way to answer is, look, it is very risky. We all read the Wall Street Journal and see what's going on with the private equity, and they're raising money, and they're, but there's some companies that are not so lucky, right, that the Wall Street Journal doesn't write about. We bring to our investors companies that we believe have potential, but we also understand the risk. So we disclose the risk all the time. And so again, best way to think about it is, look, we're going shopping, we're going to invest in a few, do your due diligence, look at them, talk to your advisor, and the advisor can provide the private equity advisor some commentary, some color to what is possible to invest in. And now you have an asset class that previously you didn't have in your portfolio. You had, you're 60-40. Now you're starting to look like maybe 50-30, 20 being half of it is private equity. The other half is maybe some real estate, maybe some crypto. Actually, crypto is a private equity asset. Most people don't see it that way, but it is. It's an alternative.
Right. If I could add something to what Howard just said, and that is that all the studies out there that tell you that private equity outperforms the public markets, none of those studies, Howard, and I'm sure you know this, are looking at a single company stock. They're looking at a bunch of these private equities, because as you correctly point out, one can go to zero, but some of them can go from investing $1 and that dollar being worth $10,000. So again, you get that benefit only by investing in a group of companies. So yes, you can get an investment where it's 1,000 times whatever you invested in, but still it is too risky. I would rather go with what the studies are telling you, that you outperform by getting a group of these companies, and that is the way to go, not by one company. Because yes, you can, for example, if you buy a lottery ticket for $2 and the jackpot is $600 million, you might say, well, that's a great investment. But how many people win that Powerball? Or how many people win that Mega Millions? You want to have an investment. You want to have multiple opportunities to invest, and not just bet on that one thing that can really boost your return, because it is just way too risky. So again, diversification. Can't stress it more than that.
We got time for one last question here, Dr. Chan. It's for you. Given your experience with JPMorgan over the years, I'm curious to hear from you as to how unique this opportunity is that StartEngine is providing to the retail investor to be able to get into these private equity opportunities for minimums, sometimes as low as $15,000 in amounts like that. I'm just curious, from, again, your experience and having worked at JPMorgan, what this opportunity is like for all these retail investors.
Well, Josh, I can't stress more than I can the fact that not only during my 25 years working with JPMorgan, but even after that, I go around the country, sometimes even around the world, to do global keynote presentations on investments. And I got a lot of clients coming up to me. And usually what they tell me is, look, I see that there are opportunities to invest in, say, a company in the S&P 500, or I can invest in the SPY, which is the ETF for the Standard & Poor's 500 stock index. But maybe I'm not happy with the rate of return that you get on regular stocks. What can I do to get that home run? What can I do to juice my rates of return? And guess what? The answer is private equity. Obviously, Howard pointed out other things like real estate, like crypto. But again, investing in alternative assets is the way to get a little higher rate of return. And guess what? Many times, investing in these alternative investments, you have lower correlation with the overall market. So to the extent that you get a lower correlation, that's an additional. One of the things I did before joining the private sector was I was a university professor teaching finance and investment courses to undergraduate and graduate students. And nobody can ever fight the fact that if you can find an asset class that is not directly correlated with other investment, that you're going to also generate a higher rate of return, taking less risk. And all the investors that I have met over my 40+ year career, they always tell me they want a higher rate of return, but they're not so excited about getting higher risk. So if there's a way to lower that risk, it's by getting an asset class that is less correlated with most of your assets that you are investing in, and that is the public market. So this is an opportunity to do that, and I really urge everyone out there to consider it. And again, as Howard says, we're not telling you to invest 100%, 90%, 80%. We're asking you to invest a sliver of your portfolio, a small percentage. You could say 10. I would actually go a little higher than 10, but 10 is good for me. That will be able to get you a little bit higher return, and you don't necessarily take as much risk if you also structure that smaller share in a diversified approach. You get the best of all possible worlds.
Great. Well, Howard and Dr. Chan, thank you both so much for your time and your insight and your knowledge on all of this. It's just fascinating to hear. And I know with all the activity that we're seeing on the comment section, I think the audience has really been enjoying this. So thank you both again for all of this. Last thing I just want to add in here for the audience is you could go to and explore all the different private equity opportunities that StartEngine has by going to startengine.com/private. Again, that's startengine.com/private, where you'll see all of the different offerings and opportunities that StartEngine has available. And also, if you want to talk to somebody on our team about your specific financial situation and what you should be doing, we can connect you with members of our team that can talk to you about what we have available in your specific situation. So you can email us at private@startengine.com. Again, that says private@startengine.com. And we can connect you with one of our representatives that can have a conversation with you about your specific needs here. So again, Howard, Dr. Chan, thank you both. Really appreciate your time. And to everybody in the crowd as well, thank you for attending, and hope this was insightful and educational. And we look forward to doing more of these in the future. So stay tuned on that. But again, thanks to everybody for tuning in today.
Thank you, Josh.
Thank you.